Hi, I'm Ashwin with over 12 years of experience in catastrophe modeling and reinsurance analytics. The topic of discussion is Bermuda insurance market and its tax benefits. We will discuss how Bermuda has emerged as world's leading risk capital. We'll also have an overview of captive insurance industry and the Bermuda insurance industry. The Bermuda insurance regulation and tax-friendly policies for corporates also will be discussed. And towards end of the presentation, we will discuss how tax loopholes are being exploited by the corporates in order to save tax. So let's have the PPT started. A tiny country by name Bermuda is competing with the likes of the US, the UK, and other Asian hubs with respect to the insurance and reinsurance industry. This could be a good starting point to understand the benefits that Bermuda offers. Bermuda is a group of islands in the North Atlantic Ocean which is in close proximity to the United States. It's a self governing overseas territory of the British. It has an area of about 54 square kilometers with a population of little above 72,000 and has a subtropical climate. It maintains a high standards of health with social security provisions as well. It has a stable political and economic climate and it provides flexible and pragmatic insurance regulation. Other countries competing with Bermuda could also provide similar advantages, but what sets Bermuda apart is its robust insurance knowledge base that it has developed over several decades. It has top notch insurance professionals and it also allows direct access to the reinsurance market. Note that Bermuda's insurance industry constitutes to about 85% of the island's GDP. As we now know the advantages of operating in Bermuda, now let's understand how Bermuda emerged as the world's leading risk capital. Bermuda's insurance industry started in 1947 with AAG Group's international business based out of Bermuda. It started to flourish in late 1960s and early 1970s when the insurance premiums were abnormally high and was extremely challenging to get property and casualty insurance cover. This is when Bermuda emerged as a domicile for captive insurance and has now consolidated its position as largest captive. We'll understand what captive insurance is in the upcoming slides. With time, Bermuda also attracted commercial insurers and reinsurers and now writes multi-class business products. BMA, which regulates insurance market, follows two-tier approach for captives and commercial insurers. Hence, the capital and solvency requirements are very different for each other. Now, Bermuda has emerged as the largest supplier of cat reinsurance to the US insurers, and they now constitute to about 36% of global property and casualty reinsurance market. Let's understand what a captive insurance company is. Captive insurance provides insurance only to its parents and its affiliates, and usually its parents are not insurance companies. This is the differentiating factor of captive insurance when compared to the usual insurance company, wherein the usual insurance company also writes unrelated risks. So, if you remember from the previous slide, we already discussed regarding abnormal insurance premiums and difficulty in getting PNC coverage during the early 1970s. And this is when the non insurance corporates created the captives and had their exposures insured. Over time, this helped Bermuda cement its position as the largest captive. The captive becomes licensed insurance company and operates under a different regulatory system than commercial insurers as we discussed in the previous slide. Let's look at the Bermuda insurer class structure. There are three types of insurers. First is the general business insurers, within which we have class 1, 2, 3 classified as captive classes, and class 3A, 3B, and 4 known as commercial classes. The second type of insurers is the long term business insurers, which writes annuity, life, and accident and health policies. Again, this has class A and B classified as captive classes, and classes C, D, E are known as commercial classes. And the third type, known as special purpose insurers, writes sophisticated and fully funded insurance and reinsurance transactions. Let's look at the structure of a captive insurance company. Starting with single parent captive, which is class 1. This captive is owned by single parent and it insures the risks of its parent or its affiliates only. Hence, it is 100% related risks. So the parent transfers the risk and captive accepts the risk by charging a premium. Claims, if any, are paid by the captive, and the captive has an option of approaching reinsurer to get the exposures reinsured. As you can notice in the second chart, there is a fronting insurer between the parent and the captive. So fronting is the insurance coverage by a licensed and admitted insurer, but without actual transfer of insured risk. Here, the ultimate risk of loss is retained by the insured through a transfer of risk to the captive insurer. This arrangement is particularly useful when in a specific territory only the licensed players can write insurance. And again, the captive has an option to consider reinsurance. Class 1 insurers are required to maintain a minimum capital and surplus of $120,000. Let's discuss multi owner captive, which is Class 2. As the name suggests, it is owned by multiple parents and it insures the risks of all the owners. Basically, all these owners are from the same industry. As we discussed in the previous slide, Class 1 insures 100% related risks, while Class 2 has an option to write up to 20% of the net premiums from the unrelated risks. So, this is one major difference when compared to Class 1, and the other difference being Class 2 has multiple owners, and Class 2 insurers are required to maintain minimum capital and surplus of $250,000. Now that we have discussed Class 1 and 2, please note that as the number of class increases, so is the increase in risk and the minimum capital requirement. As can be seen, for Class 3 captive insurer, they can write more than 20% but less than 50% of net premiums for the unrelated business, and they are required to maintain a minimum capital and surplus of 1 million. Class 3A are small commercial insurers who can have 50% or more net premiums from the unrelated business. And note that this unrelated business premium should be less than 50 million. Class 3B are large commercial insurers with same requirement as 3A, but the unrelated business premiums will be more than 50 million. And both 3A and 3B have minimum capital and surplus of 1 million. Moving on to class 4. As discussed in previous slides, with the advent of captive industry, Bermuda also started to attract insurers and reinsurers which write multi-class business. These are called open market as they are not connected to each other. And this class has become differentiating factor for Bermuda as the captives can have direct access to reinsurance locally. And class 4 insurers are required to maintain minimum capital and surplus of $100 million. Special purpose insurers write insurance risks that are fully funded. Examples of it could be the insurers set up with collateral to write insurance linked security transactions. And we have long term class A and B that write long term business risks such as annuity, life, accident, and health policies. Class A represents single parent with 120,000 minimum capital requirement, while Class B represents multi parent with 250,000 capital requirement. We have discussed in previous slides that Bermuda Monetary Authority that regulates insurance follows two-tier approach with commercial insurance capital and reporting requirements very different from captive insurers. Below table summarizes the minimum capital and surplus requirement by insurer class. The final section in this PPT is to discuss tax-friendly policies for corporates and exploitation of tax loopholes. In Bermuda, there is no corporate tax, and hence there are no taxes on profits, incomes, or dividends that are paid to a Bermuda company. This comes as a significant advantage to Bermuda insurers as there are other jurisdictions and economies which charge a very high corporate tax on profits. Please note that the exploitation of tax loopholes that we are going to discuss next is based in 1990s and 2000s. It all started with few American insurance organizations which started to exploit a loophole in US federal tax law, and by simply moving the headquarters to Bermuda or by getting acquired by Bermuda Insurance Company, they no longer have to pay any taxes. The loophole that is being exploited is the ability to collect the premiums from the US customers, transfer the same to the parent company in Bermuda, and treat it as a business expense, although the amount is being transferred from one entity to another. Companies taking advantage of this loophole can use the tax savings to offer contracts at lower prices when compared to US insurers. If US insurers too opt to lower price, it could actually dent its profits and also could impact the balance sheet. Bermuda insurers obtain profits from investing the premiums collected till the time they are actually paid out. And in the US, investment incomes are subject to 35% corporate tax and additional 5% in state taxes. But Bermuda does not tax corporate profits, that tax has a significant advantage. There are other countries that do not tax corporates, but Bermuda has become choice for insurance companies due to its light regulation and also due to its robust growth in insurance base. Let's look at drawbacks to US insurers compared to Bermuda insurers. Initially, American insurers ignored tax advantages offered by Bermuda as there was no competition, and Bermuda companies offered only reinsurance to American insurers. But later in the 1990s, a Bermuda company started to sell contracts directly to American corporates, thereby competing directly. Now, American insurers have to compete with a company that does not pay income taxes. One such example is of a large Bermuda insurer which bought a small US insurer. During the first 9 months after getting acquired, the US insurer reported 82% drop in revenues due to the transfer of premiums to its parent company. Few others followed suit and cited the tax advantage as the reason. After multiple discussions and negotiations, a bill was introduced in 2016 in the Senate to close the loophole. And this also completes our last section and also our presentation. I hope it was useful and thank you for your time. Here are my contact details. I look forward to your feedback and do let me know if you have any questions.